More and more people in today's world are looking into investing their money, either for additional income streams now or for future retirement. As the personal development industry gets bigger, the retirement age gets further away and online stockbrokers become ever more abundant. This is causing more and more people to risk their money in the stock market, as well as other popular asset classes such as foreign exchange and cryptocurrency. Unfortunately, so many people find themselves overwhelmed with the options available to them, with all the unnecessary jargon that goes along with it. There are so many people on online forums and websites, all presenting conflicting information, many of which aren't even profitable investors themselves. The abundance of opportunity online these days is a double-edged sword. On the one side, it does allow people with less capital to get started investing in any asset class they want. But the barriers to entry are so low that many of these uneducated people find themselves risking too much and consequently losing large amounts of their capital. Anyone above the age of 18 is able to open a broker account in a matter of hours and can then go on to deposit their entire life savings into that account. Unfortunately, ignorance here often leads to disaster as their capital is exposed to live markets that can wipe out that investment in a matter of minutes. The key here is to choose one method that suits your personality and interests and double down on it. Now, I don't mean put all your money on one investment and have all your eggs in one basket. I'm talking about focusing on one single method of investing and use diversification as part of that one method to spread your risk safely. Before risking your hard-earned capital, it's essential you get educated. Investing without a strategy that has a proven edge over time is no different from you betting on the horses or playing the roulette table in the casino. You will not have an edge and the markets will soon show you that. So in this video, I will explain the 3 best investment styles for 2021 with the advantages and disadvantages of each. The first approach to investing is buy and hold dividend investing. Dividend investing is the most passive investment strategy with very little time requirements necessary to manage your portfolio. As the name suggests, you just buy stocks and then you hold them for a matter of years and decades. In a dividend portfolio, you focus on buying stocks that pay their shareholders dividends. Dividends are when the company shares a part of their profits with everyone that owns a part of that company. So if you own shares in said company, you own a small part of it, which entitles you to a share of their profits, usually on a quarterly basis. Choosing those high dividend paying stocks gives a big advantage to this method. The dividends provide some cash flow to this long-term method of investing, which can be reinvested or withdrawn. The advantages of this method of investing are that very little time is required to build and manage a successful portfolio. Next is that very little technical knowledge or trading skill is required. It is of course recommended you do thorough research on each company you buy and you know what to look for, but as with the other methods we will cover in this video, you do not need any technical analysis skills. The third main advantage to this method is that the risk is relatively lower compared to the other methods. Now, to a certain extent this does depend on your own risk appetite, but generally long-term investing means you have no leverage in your broker account, meaning you have smaller position sizing and therefore less risk. Over the past century or so, the US stock market has for the most part trended up. This means that with very little interference, you're very likely to have made money if you have had the patience to just sit and hold these investments. The disadvantages to this method of investing are counter to the advantages. Sure, the risk is relatively lower, but that means your returns will be lower on average too. Another counter to this method is that because you are just holding, you just have to wait out market corrections and crashes. This means you may end up taking larger drawdowns in your portfolio because you're not actively managing and exiting positions as with the other trading styles we will cover. The other main disadvantage to buy and hold investing is that it is a slower method compared to the others. As you are holding for potentially decades, it takes some discipline not to sell early to realise shorter term profits. The second investment style is long-term trend trading. Now, rather than investing, this is more of a trading style. This is my favourite approach to the markets because it has a perfect balance between time needed and expected returns. Trend trading is a happy medium between buy and hold investing and shorter term trading. Rather than holding for years to decades, trend trading holding times are around 9 months on average. With trend trading, the idea is that you look for trends within the markets. Now, a trend is defined by price action making higher highs and higher lows in an uptrend or a bullish trend, and lower lows and lower highs in a downtrend or a bearish trend. As a trend trader, you would wait for a trend to emerge, let's say a bullish trend. You would then buy high and hold the position until the trend begins to reverse. At this point, you would have a well-positioned sell order to take you out of the market if price comes back down too far. With this method, you aim to take a large chunk of profit out of the middle of a market trend. This method is different to buy and hold investing because as you buy, you also have a stop loss in place with your broker to take you out of the asset if it goes against you too far. This stop loss is then used to follow price as the asset moves in your favour. This locks in profit along the way. Also, throughout the course of the trend, traders often buy more of the same asset as it performs well, after which they remove their risk from their existing positions. They do this by moving their previous position's stop loss to the entry point. This enables the trader to have more leverage working for them with the same risk. The advantages of this method of investing is that leveraged broker accounts can be used to increase the size of your investments. Of course, this should only be done with sound knowledge of risk management and position sizing. This enables the returns to be higher than that of a buy and hold investor because you are borrowing money from your broker to increase your position sizing. The disadvantages then are that there is inherently more risk involved with using leveraged accounts. Because you are using a stop loss to determine your position sizing, you will take more losses using this method. Another disadvantage to trend trading is that there is more to learn in terms of technical analysis and price action. This knowledge enables you to find the best assets to buy into, as you are looking for potential price increases rather than just focusing on dividends and long-term strength. The third and final investment strategy we will cover in this video is medium-term swing trading. So swing trading is a shorter term approach than trend trading, where the average holding time is around 2 weeks. Rather than holding positions for months at a time to capture as much of a market trend as possible, swing trading aims to capture individual price swings within an overall trend. This means that the stop loss is tighter than trend trading, as we want to get out quickly if we are wrong and capture as much profit as possible if we are right. The returns to be expected from swing trading are similar to that of trend trading. However, the returns can be expected to be made more regularly, offering slightly better cash flow than that of the other two methods. This is because the holding times are a lot shorter, so profit or loss is realised in shorter time frames. This method of trading would appeal to those people that have a keen interest in price patterns and technical analysis within the markets. It does take a little bit more time to manage the portfolio than the other methods, but again the returns are potentially more regular than the other methods. The main disadvantage to swing trading is that you will take more losses than trend trading and buy and hold investing. This is because of those tighter stop losses, but your overall drawdowns may actually be smaller than buy and hold investing, because you can use technical filters that keep you out of sideways markets. However, realising more losses does mean that you need to have a tough mental resilience to keep following the trading strategy even when you're going through a losing period. Whereas with buy and hold, you know that you don't have to actually do anything else apart from continue to hold your positions and receive those dividend incomes. So these are the 3 best approaches to investing in my opinion. Buy and hold dividend investing is the simplest but requires the most patience due to the time frame and lower potential returns. Whereas the shorter term trading styles require slightly more time to firstly educate yourself and then to manage your portfolio going forward. They also require a slightly higher risk tolerance and mental resilience. But this is rewarded with higher returns if it's all done correctly. Personally, I have a portfolio comprising of long-term trend trading strategy and a medium-term swing trading strategy. I do this because I have a keen interest in the markets and a technical mind that favours the technical trading styles. I hope you found this quick summary of each method helpful. If you want any more information on either investment approach, just comment down below. But as always, please like the video and subscribe to see more subconscious theory content.